Hello, everyone. Welcome to the Small Cap Insights podcast powered by Darrow Associates. We are a leading full service investor relations firm that's focused primarily on micro and small cap equities. My name is Jack Greenberg. I will be your host for today's episode. Joining us is Mario Tufano, portfolio manager at CS McKee, and the author of The Golden Age of Bullshit. Mario, it's good to have you. Of
Thanks for having me on, Jack.
course. So, could you walk us through kind of your background, what led you to being at CS McKee?
Absolutely. I started my career on the sell side at UBS as an equity analyst, covering consumer discretionary stocks. And from there, I transitioned to the buy side, where I joined my partner, Mark Roach, at a firm called Dream and Value Management in early 2007. If you never heard of Dream and Value Management, it was run by a very famous contrarian investor called David Dreaman. He was well known in the 80s and 90s, excuse me, and wrote a lot of books with regards to contrarian investing, which seems to be a little bit out of style nowadays. But that's kind of where I cut my teeth on the buy side. And I was been together with my partner from '07 till today. We were acquired. Our assets were acquired by a firm called Foundry Partners in 2016. And subsequently, this prior year, we assimilated with another firm based in Pittsburgh called CS McKee. It's almost a 100-year-old established firm, does everything from fixed income, equity, and multi-assets type of investing strategies. Currently, we're in the process of being acquired now by an Italian-based asset manager, Azimut. So that deal should probably come on the horizon in the new year, and it was announced earlier this year.
Got it. That's really helpful. And what's kind of your main focus at CS McKee?
So I manage small cap value and SMID core products. Those are the two.
And what's kind of the investment philosophy that you guys follow in the small cap portfolio and the mid core?
It's a blend of behavioral insights tied in with fundamental research. So as active stock pickers, you're going to be surprised when I say this, but we believe markets are efficient. And they're efficient at pricing in the biases of the underlying investors. And I think that's where we can take advantage of those misallocations and biases that individuals have within our process. And if you go back in time, these human biases have not changed for thousands of years. They've been embedded with us from the time we were running around in the Serengeti for survival purposes. What I call, we've been human 1.0 for a good amount of time. And it's something that it doesn't get arbitraged away. It's repeatable and successful over multiple market cycles. So we have a heavy front end that's very quantitative oriented, a lot of factors that go into it to kind of distill down our research universe within the small cap space. It's based upon value, quality, momentum. We have defined definitions for each one and factors that help us kind of dwindle down the universe to something a little more manageable. And that's kind of where our fundamental work, as well as our narrative overlay, kicks in to give us additional signals on what's truly structurally mispriced within the markets, given those behavioral biases investors exhibit time and time again.
So, yeah, I find that really interesting. And before we touch on the behavioral aspect, I'd like to ask my guests, what kind of drew you to the small cap space? What kind of merits do you think that the space has?
To the small cap space?
Yes.
Yeah, well, so initially starting when I was on the sell side, I was looking at more larger cap companies. Just that's because there was more volume in there, and that's where the research was focused on names like Home Depot, Lowe's, Best Buy, Walmart, and so forth. But on the buy side, as I started understanding what my investing style was, I gravitated to small cap in particular because of the inefficiencies and the opaqueness of that market. You find some of the largest mispricings. The emotionally driven aspect of the market can be visibly seen within those smaller cap names. And I think there's much bigger upside over time. And again, there's a much bigger downside if you don't have measures to kind of help you navigate those waters. But nonetheless, the upside can be considerable despite what has been a decade of small cap underperformance versus large cap. And even today, when you think about the behavioral mispricings that are going on in the market, if you just take a basket of small cap stocks, good quality small cap stocks, they're significantly undervalued compared to not only the larger cap counterparts, but a lot of this nonsense that's being proliferated in the market within the AI and quantum computing world, which is being technically driven by narratives. Nonetheless, it's something that is happening, but it has created an undue discount to the small cap space, which for me makes it an exciting time to be a small cap investor.
Yeah. So on that behavioral aspect, what was the genesis for that? What kind of drew you to the intersection uh, of psychology, if you will, and capital markets?
So I think inherently I've always been attracted to that aspect of the markets intuitively. But it probably was back in '99 when I opened my first brokerage account at E-Trade and I invested in three stocks. It was Sun Microsystem, Cisco, the tech heavyweights of the day, and Aetna. Oddly enough, I went with the medical company, even despite tech being the heavy hand at that moment in time. And I really learned during the dot-com bubble that there was something more than markets than just fundamentals. And it didn't really drive home to me until later on. I was on the sell side covering Sears Holding and Kmart. Eddie Lampert, a famed investor, had taken Kmart out of bankruptcy at the time, and he was going to be the next Warren Buffett. And I was covering that stock with my team on the sell side. And the story disconnected from what the underlying fundamentals were of Kmart and Sears combining, and more about the narrative that Eddie Lampert was going to be the next Warren Buffett. And that didn't turn out to be the case, right? Sun Microsystem peaked at 100 billion plus in capitalization, was sold for something around 10 billion, and Sears and Kmart eventually went bankrupt. So with those two experiences, it really was fortuitous that I found myself at Dream Value Management with David Dreaman, who was based in contrarian behavioral type of investing. And I learned a significant amount during that time with Mark Roach, who had come from a background of Natixis and Ball Nelson, and another really well-known stock picker, Cliff Hoover, who was part of Allianz and NFJ. So from them, I learned a considerable amount. And one of the books that probably solidified it for me was Daniel Kahneman's Thinking Fast and Slow. Really opened my eyes up even more. And that came out in 2011, I think, and led me on this course to be more and more rooted in behavioral finance than I've ever been.
But yeah, I'll have to check that book out. I've never heard of that. So you
Highly recommend
mentioned,
it. Highly recommend it. He was a
yeah,
Nobel Prize winner in 2002 on work that him and Amos Tversky did back in the 80s and 90s.
okay, very cool. So you mentioned inefficiencies in the small cap market. Do you think that some of those are born from these kind of behavioral biases that some small cap investors might be vulnerable to, and what kind of biases do you think they are vulnerable to?
Well, in general, it's not that highly followed of a space. So
Hmm.
there's not much information. So lack of information, dearth of information creates these anomalies and these opportunities to arise. On top of that, if you're looking at individuals that are particularly anchored to the small cap space, I think there's a few biases going on. One is anchoring, right? They tend to anchor on their winners and allow them to run to market capitalizations that reflect more of a mid cap type of company, right? So they stop being small cap and become more mid cap. On top of that, there's availability bias, and what I equate that to is kind of style drift, where individuals tend to drift over time from being purely value quality to being more narrative driven. And we see that time and time again, whether it was a dot-com bubble where you saw value guys buying growth stocks, or even coming out of the meme bubble where individuals were in, putting names in their books that was providing too much risk or
Yeah.
an undue risk. And then one final thing is that, within the small cap space, there's a liquidity constraint. So a lot of these larger AUM ETFs, and I'm not going to name them, but there's considerable amount that have a god awful amount of assets, like 64 billion. And if you
Hmm.
look at the market capitalizations underlying it all, they're more SMID, right? Like 60% of the companies they have in that portfolio have a market capitalization that's higher than 6 billion or 8 billion, right? So they're more SMID oriented. So you have a bunch of factors going on with the small cap space due to lack of coverage, illiquidity, and emotions that are tied more to individual biases than in other areas of the market.
Yeah, I think that's really important. A lot of the people that I talk to emphasize the importance of being able to separate your emotions from investment decisions, knowing when to take losses or to take gains. So I think that's really important. So can you walk me through the process of what led you to writing your book, The Golden Age of Bullshit? What kind of what gap, I suppose, were you trying to fill?
Great question. If I think back to the meme bubble I just talked about in 2020,
Hmm.
2021, a lot of the nostalgic names of my youth, like Bed Bath & Beyond, GameStop, and AMC, were trading at insane valuations compared to what their fundamental reality was. And it was during this time where I recognized that the market had become so disconnected from reality. And it was AMC in particular in June of 2021. And there's a story that I tell, it's the first chapter of the book, where I tell the story of AMC and the CEO going on a podcast or a YouTube channel. And in the middle of it, the camera falls and you get a glimpse of the CEO not wearing any pants.
Yeah, I remember
It
that.
reminded me of the story that the Emperor's Clothes, where an individual or two individuals go to an emperor back in China a long time ago, and they try to sell him some garb, some clothes, and they say these are invisible clothes, and they convince him to wear basically nothing, and he's naked, walking around naked, but everyone else believes that he has clothes on, telling him, oh, they look great, and it's the kind of group think that's occurring until one day a child speaks up when the emperor is speaking in front of a group of individuals, says the emperor has no clothes, and everybody else goes, listen to the child, the emperor has no clothes. And that thing reminded me of the AMC CEO at 2021, when AMC's trading at god awful levels compared to historical standards. And what really made me recognize the amount of nonsense we swim in on a daily basis, when I was going through a new brokerage app called Webull.
Mm-hmm.
On this app, there was a thread in discussions with AMC. And I came across a picture of a woman kissing her college-bound son. And the son's dressed in his graduation gear. And she writes, I'm a retired war veteran. I don't have much. College ain't cheap, but I'm holding on to him. And she's referring to AMC in particular, the entire thread. And this is in June 2021, when the stock has just reached an all-time high a few days ago. And up, 20, 30, 50 times, depending upon where you look at it. So egregiously overvalued. But the most concerning part of this post was not that she bought the stock, not that she potentially lost money, but that there were 174 likes and 0 dislikes, and comments encouraging her to do that. And this reminded me of a story my dad told me when I was younger. I was a kid, about 10 years old, about a bullshitting cat. And the underlying story of it, and you could tell it as a thick Italian accent, El gatto con la bella faccia, was that be mindful, be skeptical of individuals that are trying to take advantage of you. And that kind of snowballed my interest in unearthing the kind of world we live in, given the dynamic of this, right? The combination of smartphones and social media, and how that influences people on a daily basis. And we see those influences most readily within the stock market, but it's happening in every aspect of life. So the book kind of tells stories throughout, talks about that on the first chapter. And I don't put a negative spin on it. There is positive to it. There is some good that comes out of hype, but nonetheless, the book prepares you to be mindful in a world that's evolving at a faster pace than our mind's ability to adapt, right? With technology, AI, generative AI, and deep fakes, we need to be better prepared for this world. We need to go from human 1.0 to human 2.0. And that's the goal of the book.
Yeah, and I highly encourage all of our listeners to go give the book a read. I think Mario did a great job. And just two final questions here. If you were to look ahead, kind of on a 5 to 10 year horizon, are there any industries, kind of themes or investor mindsets that you think will present the biggest opportunities for value creation going forward?
Now I'm biased. And you're always going to know what my answer is going to be, but I think we are, from a generational standpoint, at an immense opportunity for small cap. I really do. It's If you look back throughout time, there's been few moments where small caps have traded this cheap. And I do think it's going to be a generational trade. If you think about since 2011, small caps have underperformed their large cap peers by about 500 basis points. Most of that, all of that, is not due to fundamentals. It's not due to discrepancy in earnings growth. It's all due to valuation.
Mm-hmm.
Large cap multiple has increased, while the small cap multiple is going nowhere, sideways. So if we look at the EV to cash flow of the S&P 500, which is a rough proxy of large cap. I know it's tainted a bit given the Mag 7, but nonetheless, it's a rough proxy of large cap. It's at 22 times. If you look at the 600, which is a S&P 600, which is a quality small cap benchmark, better than the Russell 2000, it's at 15 times. That's a wide gap. It's like a 2 standard deviation away from historical standards. I think there's a mass opportunity there.
Yeah.
In those space and industries that I'd be positioning, I think energies, commodities, and infrastructure are going to have huge pivotal roles to play in this new world that's on the horizon, whether it's electrical vehicles, AI, and quantum computing. We need to get a better handle on our grid because energy is going to be massively consumed with the consumption of these data centers. So I do think energy has to play with that. And it's not just going to be nuclear energy. I do think nat gas has a massive role to play in that. So I think nat gas names within the space seem very, very attractive. Within commodities, when I got out of college, I remember in 2002, the theme was commodity super cycle driven by the BRICS, which was Brazil, Russia, India, and China. Those were the monikers. And there was peak oil. That was the talk of peak oil. Peak oil. That's why oil went up to like 150 or 160 in the way. 20 and tech was unloved. Tech was obsolete. What happens 20 years later, 25 years later? Tech's the only game in town. Oil and energy are nowhere to be loved within the benchmarks as a weighting percentage, right? Everyone thinks we have a peak supply of oil around the globe. So I think that's going to flip on its head because the onshoring of manufacturing, the deglobalization of the world, as we've seen with these tariffs, and the signal that gold is giving us, makes me believe that we're going to be entering a super cycle in the commodities. So I think energy, commodities, infrastructure, massive way to play it. Small versus large is another massive way to play it.
I really like that answer. And kind of final question here. If you could leave the audience with one kind of guiding principle for investing in the small cap space, what would that be?
Patience.
Mm-hmm.
We've seen one of the worst decades to be a small cap active manager, particularly value quality oriented. Because you had the 2021 meme craziness and the post-COVID euphoria. And then now you have this AI quantum computing junk rally that has dominated. I mean, active stock pickers are getting decimated this year. So I think patience is one of those things. And if you look back since the 1930s, there's been 3 periods where this has occurred, where small cap has underperformed this massively. It was the 1930s, coming out of the Great Depression. It was the post-World War II period, and then it was the dot-com bubble. And each time, small cap underperformed, value underperformed by a considerable amount, like I said, on the realms of 500 basis points a year. But coming out of that, they picked up 1,000 basis points a year. And it wasn't just for a few years. It was a multi-year period. So I think patience on individuals' behalf will do them well, because when you look out 10 years from now, the most attractive space to me is really small cap within the US domestic markets. And again, unless you assume human behavior has changed and we become more rational in our thinking, then maybe that's not the case. But if you still believe that humans exhibit these biases and they have these tendencies to overreact and underreact, then you want to be in small cap when the tide turns. And it could be happening right now as we speak. We might be at the early beginning infant stages of it. And you don't want to wait too long, because when it moves, it moves.
Yeah. So Mario, thank you very much for coming on the podcast and offering your insights. What would be the best way for listeners to kind of catch up with you and access your book?
So first, you can just go to my LinkedIn site, and I have the link to Amazon for my book there. Also, CS McKee has a ton of information with some of the good work we do, and other strategies that people might be interested in, and white papers that we've written over time. So those 2 places are your best bet.
Got it. And I will include all of those links in the description. Be sure to follow Darrow Associates on social media. Thank you all for tuning in to another episode. And thanks again, Mario. I hope you have a great day.
Jack, you as well. It was a pleasure speaking.
Thank you.
Take care.